Today we're going to talk about index strategies, renewal rates, what to look for and what to avoid. Hey everyone, welcome back to this week's podcast. I am Chad Owen. I'm not even going to tell you, the Annuity Sales Coach, owner of Retirement Realized Financial.
And Retirement Realized Agents Academy.
There you go. Dubbed in.
And I am.
What are you today?
Who am I? Today.
We don't even have a name for him. We don't speak it.
I'm trying to think of something good. And I can't. I'm trying to get past the boy wonder, although maybe I'll just brand myself as that in the industry.
We're gonna do this big old sign in the front of our building that's gonna say boy wonder.
Okay.
Okay.
With my photo?
Sure.
You're gonna have people coming from far and wide to see that, Chad.
Well, now that you've grown your beard in, that might work. Okay.
Oh, man. All right. Index strategies and renewal rates, what to look for and what to avoid. Just right off the top, Chad, what's your take?
So indexes are one of those funny little creatures. We used to, when I got into the business, was real big into the S&P, the Dow, the NASDAQ. There's a lot of annuities that use those strategies based off of the brats. And I call them the brats because they throw a fit and then they're happy. They throw a fit and then they're happy. I mean, the brats, their temper tantrum is a 50% loss in the market.
Sure.
But they're very temperamental based off of news. So often you'll see news stories come out at 12:01 a.m. and then you'll see the market get hit that way, whether it's for or against. And it's funny, I'm convinced, now this is not a conspiracy theory, this is just something I've observed, that it's interesting how news comes out 12:01, 12:02, 12:03 a.m. negative, and then the market hits bad. Now you can say, well, they're just reporting what's going on. It's funny because some of the stories they report about hadn't even happened yet. I remember this one where they were talking about banks having an issue and they named something very specific. And there was no way in that time zone where it was announced that it could have possibly even happened yet, and then where it actually happened in.
No.
And I'm going, because obviously, you go for it. I've done a lot of traveling. I mean, it can be a day ahead in another country. But I did the time calculation. I'm going, when you announce that happened, 3 hours later from the time our time zone in the new time zone, 3 hours after that is when it actually happened. I'm like going,
That's weird.
Can you get insider news? Absolutely. But it's too common stuff like that happens. Sure. So the Dow, the NASDAQ, and the S&P, those are just very temperamental indices. I tend to like some of these volatility control indexes. I like annual point-to-points a lot. Yeah. A 2-year point-to-point can be appropriate in the right situation, as long as you do the stagger, the 50%. In the 1 year, then the 50% the 2 year, and then the next year you turn the 50% 1 year into 2 year. Then you have the staggering returns. Every 2 years you have one of them crediting. And the reason why that can be advantageous is because you have a higher participation rate when you do that. That being said, I'm still a pretty big fan of 1 year point-to-points. If I can get a 1 year point-to-point with a good historical off of it, that's what I'm generally going to use. I also don't like indices that have a built-in fee. I just don't. We try as indexed annuity people, fixed annuity people, to get away from the perception of high fees.
Right.
So if you have a 1.25% fee on the index and you have a 1% fee on the rider, now you're paying 2.25%, and you're trying to explain why their 3% fee on a variable annuity is too high.
Right.
So I don't like indexes that have fees on top of that. And then the other thing, I don't really care for indices that have two limiting factors. So if you have a cap and a spread, I don't like that. If you have a participation rate and a spread. That being said, there are some I have used. It just depends on the company and the rate integrity. So I'm real big into learning the rate integrity of companies. How many companies have I seen over the past 17 years that they tell you it's one rate, then when you go to the next year renewal, it drops dramatically. And so there's a handful of companies out there that have a high rate integrity. And if you don't know what those companies are and you want to get contracted with us, you can absolutely do that. But I'll tell you, companies with high rate integrity will keep a lot of issues in the future from happening.
Yep.
You have clients that don't get ticked off because their 70% participation rate dropped to 40%. I personally have never carried a company that's done that, but I have seen companies that have done that.
They fixed their implied volume.
Oh my gosh. Well,
there's whole formulas that go in, and I could nerd out on that stuff. I won't nerd out.
Don't nerd out.
I'll save them that for another day.
When they call you and ask for information, then you can nerd out. But remember, you have a limited time.
I got a limited time. But there's a reason that the S&P historically has lower participation rates, and a lot of times they use caps on that index. And the reason that they're lower par rates and caps is because that is the S&P, the NASDAQ, all of those that you call brats. It's more expensive, to put it in layman's terms, it's more expensive to hedge against those indices than volatility control indexes. So that's why you see higher par rates, higher caps, lower spreads on vol control.
And it's also more expensive too when you have a shorter time frame than a longer time frame. So when you have a 1 year point to point, that's more expensive for them to do than a 5 year point to point.
You benefit from the reset because
I'll tell you, do not do 3 and 5 year. I just had to replace an annuity from someone that I wrote 6 years ago, and he was on this second 3 year time frame. And fortunately, this last 3 year did pretty well for him. But I don't think the next 3 years are going to be that, because of the MVA. It's the first annuity I've ever replaced in 17 years that was my own annuity that I wrote. So in other words, there's a guy in my area that sends out letters to his clients saying, hey, you bought this annuity from me 4 years ago, and I think it's time to replace it. And he uses the bonus to outweigh the surrender value, but what he doesn't take into consideration, or he doesn't care, is the income of account value is already super high. And I hate that. Like I am turning them into the insurance commissioner. I'm waiting to deliver this policy, and this client actually has the letters where he's shown that. I've seen 2 clients with that. I've seen 3. The one won't give me the letters, but the other 2 will. And so I'm going to turn them in. And it's the first time I've ever replaced an annuity that I've personally written. And the reason why is because when I do that, I'm confident in what I'm putting them into.
Right.
But because of the MVA, the surrender value is actually completely wiped out, which is really nice. There was no surrender charge in this. If there was a surrender charge, I wouldn't have done it.
Yeah.
So, yeah.
There you go. So renewal rates, obviously very important. Some companies publish them, others don't. But if you can find that rate history for whatever carrier you like or have been selling, you can go back and you can check to see what do their renewals. And if you've been in for a while, you'll have come across the renewals, the statements, the reallocation, whatever you want to call it, those annual, 2 year, whatever it looks like. When that reset is up and you go to reallocate, you'll see what their new rates look like. And so you'll have a pretty good idea of what companies out there do have good rate integrity and and who doesn't. But if you're new, you can look for published renewals. The other thing,
there's one company that I've written that I really regretted. Fortunately, I only wrote like 8 policies, but they had a 5 year point to point. And I'm telling you, the way they explained it was towards the beginning of my career. And the way they explained it sounded like peaches and cream, man. It sounded like there's no way they could lose. And I had a client go 5 years earning nothing, even when the market did go up. And it was really frustrating because, I mean, I did my due diligence. I studied the product. I studied the disclosures, and what they said happened didn't even close to happen. Yeah. So it's frustrating.
Well, the carriers. So when you go back and you look at historically, you've got back in the day S&P, NASDAQ, those high volatility type of
brats.
Yeah, the brats. Yep. And then the insurance companies started getting creative with their vol control. Now insurance companies are getting creative with the way that they reset. So their reset period, okay, and then the way that they index those, right? The way that they actually, and I for the life of me cannot think of the name.
That's okay. I would just rather leave it at that. That way we don't have to keep hearing you talk. There's
a specific word, and I cannot
but I can tell you
get
close to that nerding out moment, and it's like So, yeah,
Right
it's
there.
okay, Caleb. What are we talking about next?
No, it's right there. I cannot think of it.
Think of a nice 10-point buck walking out to deer feeder.
That's just distracting.
I know, that's what I'm saying. Now you'll never remember
Yeah.
it.
Golly.
Symmetrical.
I'm going to think of
scores
it, and when I
230.
do think of it, I'm going to come back
Right,
and I'm
your
going to say it.
crosshairs, gently eating the corn,
Oh
not
my
moving.
All right, well let's do move on then to the next one.
Win for me. Thank you.
Carrier illustrations.
Yes.
God bless these insurance companies that have
Most of
10 years of phenomenal market performance.
Uh-huh.
So when they have to show on their illustrations last 10 years, whether that's back tested or live data from the index, regardless, they look amazing. You see best of, some of these carriers are showing 9, 10, 11, 12%.
They can, but there's also some, like I use one right now that actually has shown just barely under a 6% return over the past 10 years. And its best 10 years was not the last 10 years,
Right.
because it's a volatility control index.
Sure.
So that being said, I like Texas where and a lot of states do this too, but you have to show the best 10 years, the last 10 years, and the worst 10 years.
Yep.
And they go back anywhere from 20 to 30 years in 10-year increments. And I like it when they do that. But, I think I get where you're getting. You got to be careful.
Talk about realistic returns.
Realistic terms. I mean, if somebody's telling me they have a 14% 10-year return, I'm very skeptical of that happening again. I'm not saying that didn't happen.
Sure.
I'm just saying of it happening again.
Yeah.
Like, I've told you this, you and I have talked about this many, many times. If somebody tells me I have the best for a 10-year return of 14% and your worst 10-year return is 2%, that's too great of a spread.
Right. So here's the thing with those that show that. You're not going to find any index strategy, allocation strategy, whatever you want to call it, that's based on what you call the BRATs, these long-lasting, lots of history indices. They're almost always with volatility control indexes, most of which are not even 5 years old.
That's true.
So much of what they're showing, when they're showing you 9, 10, 11, 12% or more on average over the last 10 years, you're looking at a lot of back-tested data, which great. The back testing process is also,
and those numbers are real.
They're
if it did exist, that's what would have happened.
That's what it would have done. But it's also taking into account current insurance company rates.
Correct.
And the reset options.
If I was a stockbroker and I went back 20 years ago, I would be a billionaire, hands down now. I would have just bought some crypto at the right time. I actually would have probably bought
hindsight's 2020.
Apple, Microsoft, Amazon. And then when Bitcoin first started, I would have just loaded on that, and then I would be a cajillionaire now.
Yeah, hindsight's 2020. But that's what I'm saying is it's taking into account things that it either wasn't around for, which again, yes, the back testing is great data, or two, the current rates. So if you have a carrier that is showing you 9, 10, 11, 12% returns over the last 10 years. And let's just say for the sake of this example, they're using 150% par rate.
Yeah.
Okay, on that index strategy.
Yeah, but in all fairness, so I know where you're going with this, but in all fairness, we got to know that it is still based off of the 10-year treasury, as you know. And the illustration rates are based off of what that current rate is. So I remember there was a time where I saw a company, they had a 115% participation rate, where that same company now has a 90% participation rate.
That's what I'm saying.
Yeah.
So if they assume that, if this index was around 10 years ago and had performed over this 10 years, this is what the index would have done based on our super high participation rate, but we don't have good rate integrity, that's an inflated number that you won't expect to repeat itself, because you can be sure that they're likely to drop their rates if they don't have good rate integrity, in which case it drastically affects the actual return.
Boy, it is so important. I'm going to stress this again because this is really important to remember. Always use companies that have high rate integrity.
Yep.
And always question a company that doesn't publish renewal rates. If you can't call your company and say, hey, I want to get an illustration, I want to see what your participation or your caps were for the past 10 years. If you can't get that, that's a concern to me.
I thought of the word that I was trying to think of a little bit ago. Crediting method. My goodness. Who would have thought
That's
that'd be
what you
so
were trying to
hard? Well, the thing was, like, I know it. I say it all the time.
I know.
It's not a hard,
That's
but it
an
was
easy
like
term.
buried in my brain. But they're starting to get creative with their crediting methods.
Yeah.
Carriers are coming out with their own proprietary types of credit, new ways of crediting, all these types of things, and then mixing that with their reset periods. They're starting to create a lot of differentiation on those two fronts, reset period and crediting method, and some of which you need to really dig into.
Some you got to be very aware. Is this a marketing kind of
most of
carrot,
the time it is,
or is it someone being innovative with what's going on? And that's where you really have to look at the company you're dealing with.
Yeah.
You know, pure market innovation. I mean, you could go back before the index annuity started, and I'm sure you could have someone going, yeah, this is a scam, this is a ploy, something's going on, this index strategy, these indexed annuities are a bunch of bull. You want to know why I know that? Because when the income rider first came out, it took me a year to get into the income rider. And now I am an income rider junkie.
Oh, yeah.
Why? Because and I don't know about y'all, you may get clients that have more than enough income and they never have anything to worry about. That is not my client base. My client base is one of the spouses passes away, they are in trouble. And if they don't have joint lifetime income, they are in trouble. And if one passes away and loses the lower of the two Social Security, that surviving spouse is going to need income. Yep. So, I mean, like I said, I think it's funny because a lot of people have this perception that I'm in this super high-end area where I have people that have millions upon millions of dollars, and that I show up to the house and they got all their statements laid out, and they're like, please, Master Chad, help us. It's like, no, it is not that case, man. I've had big deals. I just had a big deal. I had a $2 million deal that I wrote, and they backed out on it. Fortunately, it was not issued. The money wasn't transferred, but I still don't know what happened. Yeah, everything went perfectly in that appointment. I met with them 3 times, and then they said, you know what? When you get back, let's meet again. I'm not ready to actually sign any checks yet. I'm like, no problem, no big deal. And then they sent me
bad
an email.
Information.
And it could be something that simple. They could have talked to one person, having an opinion, and they just changed their mind. I don't know. I mean,
the influences out there, we don't even know the half of the things that are, and the people that are influencing clients that you're meeting with.
But that's why I tell people, do not get emotionally attached to the money. Right. It's not about the money. Yeah. It's a solution. Absolutely. I did my job. I found a solution for them because they chose not to take it. That's not my fault.
Right. Yeah. They gotta want it more than you do. Okay. Last thing I want to hit today is talking about allocation strategies. Okay. I want to talk specifically about some ways that you can structure the way that you allocate to the different index options within a product to try to obviously maximize returns. But I think that there are some ideas historically, talking about diversification within allocation, and I think it has its place depending on the way that you're allocating. I think also that there are times where 100% allocation into one index strategy could be warranted, and it really depends on what's available there to you. But there's a couple of notes that I want to make on that. And first is, if you're dealing with qualified funds and RMDs are really in the picture, or you're dealing with an income type of product, I would highly, highly, highly recommend you set up their index strategies in a way to where you're trying to credit something back to them each year. Because if you're taking RMDs or you're taking income, you're drawing things down. So if you're not simultaneously crediting back for 2 or 3 or 4 or some 5 years, you can really have these things sucked down. And now you're trying to credit. It can create a big potential mess. Yeah. So try to credit back each year.
Well, and I'm very realistic. Remember, I always sell off of worst case scenario. So when I'm comparing any index, I'm always saying, remember, your worst case scenario is you earn 0 for the next 35 years. Yeah. And your death benefit goes away, but your income doesn't. That's what I base everything on. Right. But then I do, this is what it's performed over the past 10 years. This is the worst 10 years, and it's the best 10 years. But the reality is, always base everything off of the worst case scenario,
Yep.
which is your income guarantee.
Yep. So yeah, use a mix, annual point to points, 2-year point to points, whatever that looks like for you. The other thing that I would encourage you to take note of is, are these back-tested returns, these annualized average returns, coming because of super high par rates or super high caps or super low spreads, or are they coming because the index has actually performed well? Yep. And that's one thing that's definitely worth looking at, is what has the actual index done? Yep. And can that index return good returns with moderate par rates, moderate caps, or moderate spreads, or does it have to have those super high pars, super high caps, super low spreads to try and create those returns? If you're dependent upon what the insurance company is willing to give up to create those returns, that's a little bit of a, in my opinion, a little bit of a hairy dependency there, because all it takes is they change their rates one time, and now that index does not have the history or the ability to perform.
Though, if you have companies with high rate integrity, you don't have to worry about that.
That's what it all comes down to.
Okay, so I hope this helps you. I hope you're not more confused now than you were when you started. So
give me a call. Just call me.
Yeah, give me a call. And then you'll be even more confused. So, okay, we'll have a great day and happy selling.